Your viewpoint is kind of nuanced. It'd be unlikely for us to see a second 10% correction in the S&P within 9 months. It's never happened since 1940, right?
Yeah, I think.
But it's weak, and the recent developments put us in a vulnerable position.
Sure.
Right?
I mean, everyone wants a correction, right? The market was up almost 19% through April. Everyone wants a correction, and then you get a correction. Oh, I didn't want it for that reason, right? And so I think you're getting a pullback. The reason you don't have two 10% corrections is because everyone got so bearish after the first correction, they never actually got back into the market. So the percentage of bullishness is so low right now.
Well, somebody got back in the markets.
Well, I think it's corporate buybacks, but retail investors, institutions, the percentage bulls is very, very low right now.
But you're surprised.
So I think that's why you don't get a second 10% correction.
You don't.
Because there's not enough people to panic.
All right, but at the same time, you're surprised the S&P is down only 7%.
Well, on the surface.
You're surprised considering all China trade, weakening U.S. Economic data, the yield curve, the Mexico tariffs. You're surprised it's only down 7, but you don't expect it to go down 10. So what do you?
I think we're in the range. I think.
You think we're in the range of bottoming?
2650, 2750. And yesterday was a very significant day because what you saw is the losers that had already sold off. They stopped going down, the value stocks, financials. And the last things to sell are the things that people have made the most money in, which is software stocks, tech, the big tech stocks.
Is there a change with this now, these investigations into technology?
That could be very true. Absolutely. And that could cause the rotation into the things that were the most sold off. This is exactly what happened in December. The things that rallied were all the risks bottomed and started to work into the bottom. Financials worked, energy worked, industrials worked. That's what happened yesterday. Yeah. So I think you could get a rotation. You needed some type of catalyst to cause the rotation, and I think you're seeing it.
I asked Santoli yesterday as we watched 4 people standing on a porch, and now they're no longer standing. They're going back in. That looks like 10 Downing. Yes,
that's where the president's going in to be meeting
Theresa
with business
May
leaders, Theresa May,
husband, and the First Lady and President Trump. That's a very well-known porch, and you could tell without even seeing the address. I asked Santoli that yesterday, actually. Does it seem like the selling kind of dry? I mean, 6 weeks.
Exactly.
Kind of drying up. We'll see. All we need is one more,
bad.
Put some tariffs on Canada or something. I don't know. Julian, when I was on Fast Money, which, by the way, I'm going to be on Fast Money tonight. If I can just say that, Fast Money, 5 o'clock
You're
tonight.
working a full
long day.
And tomorrow night, and back to back. So I don't know if I can come in on
time
Thursday.
and a half?
No. Anyway, I know, shameless. I'm going to tweet that out. No, but last time you were actually on with me on Fast Money.
Cancel all my meetings at 5 p.m.
Yeah, DVR. I know you've got the capability. So last time you were on Fast Money, you were pretty bullish, and you still are, I think, but there's a couple of these things there's a wrench in the works with Mexico tariffs, and now you're willing to concede that lower might come first before 3,000 or 3,100.
We think so. So I think yesterday.
You changed.
Yes.
You changed.
The bigger picture has not changed.
Okay.
We think ultimately you're going to get to 3,000 at the end of the year.
And higher, maybe. Not anymore?
Not as much.
You thought maybe 31 or 32.
I mean, frankly, I think there's a surprise that we're going after Mexico in the way that we are.
That's shocking.
There's probably a surprise, certainly what we heard in Chicago yesterday. There's a surprise that the trade war in general is as entrenched as it seems to be. And I think the Fed is cognizant of that risk. Ultimately, we think that's why that they're going to end up cutting rates, one of the reasons later in the year. But we do think there's a little bit more work to be done sort of sideways to lower. And actually, this rotational selling, we think that the bond market has overdone the case for growth slowing down. Stocks don't reflect it quite as much. And so for us, the places that are vulnerable in a market that's waiting for better news are the ones where people have hidden. Utilities, consumer staples. Again, technology is likely vulnerable simply because the government has put a spotlight on it.